Roth conversions are one of the most powerful retirement strategies available, but there's a hidden trap that catches a lot of people off guard. If you don't handle the taxes correctly, you could owe an underpayment penalty even if you pay every dollar you owe by December 31st. In this video, we'll walk through how the IRS looks at Roth conversions, the smart way to pay the taxes, and how to avoid penalties, including a cool tax withholding trick that you can utilize if you do your Roth conversions at the end of the year. If we haven't met, my name is Jake Skelhorn. I'm a certified financial planner and one of the owners of Spark Wealth Advisors, where we help clients across the country with investments, taxes, and retirement planning. If you find this video helpful at any point, please consider subscribing to the channel and sharing this video with a friend. With that, let's dive in. As some of you may already know, a Roth conversion is simply taking money from your traditional IRA or 401k, which is pre-tax, and moving it into a Roth IRA. When you do that, you pay ordinary income taxes now on the converted amount, but then it grows tax-free and comes out tax-free in retirement. Roth conversions are a popular tax planning strategy because once your money is inside a Roth, it's shielded from future tax rate hikes, you don't have to take required minimum distributions, and it gives you more flexibility in retirement income and withdrawal planning. Normally, when you're taking money out of a pre-tax account like a traditional IRA or 401k, you pay a 10% early withdrawal penalty if you're under 59 and a half. But when you do a Roth conversion, the conversion itself isn't penalized, just taxed. The only time a penalty applies is if you withdraw the converted funds before 59 and a half and before the 5-year rule has passed. But what can trip people up is this. You may owe an underpayment penalty if you don't pay the applicable taxes on that conversion at the right time. If you don't pay a certain percentage of your total tax liability throughout the year, the IRS penalizes you on the underpayment amount. The penalty resets quarterly, and for Q4 2025, the underpayment penalty is 7%, so this can add up quickly. When it comes to paying the taxes on your conversion, you've got two main ways to do it. You can withhold taxes directly from the IRA when you convert, or you can pay the taxes from a separate account, usually a taxable brokerage account, by making a direct payment to the IRS. It's almost always preferable to go with option 2, which is pay the taxes from your brokerage account, because that allows 100% of the money you're converting to land inside your Roth where it can grow tax-free. If you withhold from the IRA, you're basically shrinking the amount that actually makes it to the Roth. For example, if you're converting $100,000 to Roth and you're in the 22% tax bracket, you'll owe about $22,000 in taxes. With option 1, withholding that amount means only $78,000 ends up in the Roth IRA, growing tax-free. With option 2, you're basically taking that $22,000 from an account where interest, dividends, and capital gains are taxed each year and putting it into an account where all that is tax-free, the Roth. But here's the catch when it comes to doing Roth conversions. The IRS assumes your ordinary income is earned evenly throughout the year. That's true whether it's wages, consulting income, or a Roth conversion. So if you wait until December to do a big Roth conversion like so many people do, the IRS looks back and says, hey, you should have been making payments in April, June, and September too. And that's where underpayment penalties can sneak up on you, even if you pay the full bill in December. So what do? Let's look at some of the solutions. There are really three main ways to avoid getting hit with a penalty when you're doing Roth conversions. Number one is called the safe harbor rule. If you pay 100% of last year's tax liability, or 110% if your adjusted gross income is above $150,000, the IRS considers you safe. No penalties even if you have a giant conversion in December. The safe harbor rule also is met if you pay at least 90% of your current year's total tax liability through withholding or estimates. The second option is filing Form 2210, specifically Schedule AI, with the IRS. If you don't want to withhold and you don't meet the safe harbor rules under last year's figures, there's still a backup. You can file IRS Form 2210, specifically Schedule AI, that lets you show the IRS that income really did arrive later in that year and not throughout the year, so your earlier quarters shouldn't be penalized. It's more paperwork, but it does work. Option 3, again, is withholding. If you don't have the means to pay the taxes from another account, you can withhold taxes directly from the IRA, as we mentioned earlier. Similar to the way that income is treated, the IRS treats those withheld dollars as if they were paid evenly throughout the year, even though they weren't. So as long as you're withholding the correct amount, this should avoid underpayment penalties. Now here's the trick I mentioned at the beginning of the video. If you do have the money to pay the taxes out of pocket in a brokerage account, but don't want to deal with the added tax forms or estimated tax payments, you can withhold taxes on your conversion and then do a 60-day rollover of the withheld amount by wiring it back into your Roth IRA. A 60-day rollover is simply redepositing money that was withdrawn, not rolled over, from a retirement account within 60 days of the withdrawal. If done correctly, no taxes are owed on the withdrawal. Using the same numbers from the earlier example, you would withhold $22,000 for your $100,000 conversion at the end of the year. That $22,000 is considered a withdrawal since it's not going to a retirement account. It's going to the IRS. So you then take $22,000 from your brokerage account or bank and wire it into your Roth IRA to complete the 60-day rollover, all while satisfying the IRS. This is definitely a more complex strategy, and you can only do a 60-day rollover once every 12 months, so speak with a tax professional before DIYing this one. So here's the checklist I would follow to make sure your Roth conversion taxes are done properly. First, check if you're covered under those safe harbor rules. If yes, you can do a year-end conversion without any worry. If not, you can either do the conversion in Q4 and use IRA withholding to wipe out any penalty risk, or go the Form 2210 option to let the IRS know that your conversion income was not realized throughout the year. Finally, there's always the option of doing quarterly or semi-annual conversions and paying the estimated taxes each quarter. In my opinion, this creates a little more work than necessary and leaves more opportunity for mistakes, but it's not a terrible option. The bottom line is this: Roth conversions are one of the most powerful retirement strategies out there, but the timing and the tax handling matter just as much as the amount you convert. Do it wrong and you risk penalties, but do it right and you get more money growing tax-free forever. If you want to learn more about what we do for our clients, visit our website at sparkwealthadvisors.com. Thanks for watching, and we'll see you in the next video.